This is Michael Douville coming to you from beautiful Phoenix, Arizona. It's Saturday, August 22nd, and this is another Creating Wealth seminar. Now keep in mind, West USA sponsors a Tuesday webinar, and of course last Tuesday we talked about the different asset classes because there are many other asset classes. You know, if you talk to some financial advisors, they only think there's two, that's stocks and bonds, but that's not true. There's many, many different asset classes. The first five, or the most major five, are stocks, of course, those are very important, bonds, commodities, cash. Cash is really considered another asset class, and of course, there's real estate. And real estate is absolutely a different asset class, and it's not correlated very well with the stocks and bonds. So real estate does not correlate with Wall Street. So when Wall Street hiccups, real estate doesn't necessarily follow along. So when you're looking at your asset classes, you have choices to make as to which choice as to where you're going to invest your money. So if you go into stocks, stocks have been a very, very good store of value. Now stocks have cycles. So sometimes it's really good to be in stocks. Sometimes it's not. Sometimes they're risky. Sometimes they're not. Right at the moment, they're fairly risky. Now, they've done very, very well. But keep in mind that we just put in $6.3 trillion into the marketplaces. And of course, stocks and bonds are very liquid. And when you put liquidity into the market, you go into the most liquid markets. And that, of course, is the stocks and bonds. And that has reflected the fact that liquidity comes in. Now, stocks generally are reflected on earnings. And of course, we're coming through a terrible earnings period. A lot of these companies have no earnings. I mean, we still have 21% unemployed, down from what, 40%? It's awful. So it's much better than it was, but nowhere near what it was before. And yet most of these stocks have recovered, and some of them have actually gone more. So you have to say to yourself, gosh, you know, what kind of risk are we running there? Same with bonds. When we're talking about bonds, when we're talking about bonds that are at 0% or 0.15%, or a 10-year treasury at 0.7%, this is pretty historic lows. So the odds of interest rates going up, in which case then you have an interest rate risk, is pretty high, much higher than them going below zero. And of course, now credit risk is also entered in because we're in a recession. So the government, the Federal Reserve, is propping up a lot of companies that probably should have folded. And they're getting easy money and they're keeping people employed, but they're not earning money. They're what we call a zombie company. And of course, they're at risk. They're at a credit risk that they may default on their bonds. So you need to talk on both instances. Talk to your financial advisor. Find out what's prudent for you. Find out what's good for you. Find out what works really, really well. Now, I'm not going to talk about commodities too much, or cash, or precious metals, which are really part of the commodities, but a lot of people break those out. We want to talk about my favorite asset class, and that, of course, is residential real estate. Not retail or warehouse or industrial or land. We're talking about something very, very, very conservative. This is a asset class that cash flows, it consistently cash flows. You get a monthly cash flow. And quite honestly, when I buy a property for a client, I pretty much expect that property to start cash flowing the very next month. So we get our cash flow shows up almost immediately. We're buying cash. We want this to happen. Now, keep in mind, in the great markets of the country, Florida, Texas, and of course, Arizona, we have tremendous demand has entered into the marketplaces, and rents and prices are going up. These are just great, great markets, and they are not correlated with Wall Street. So if Wall Street crashes, it has trouble. If it struggles, regional real estate is not. It's a basic shelter need. So if you have a good property in a good neighborhood, and you screen your tenants, keep in mind, you want to make sure. Sometimes I think you're better off getting a better tenant and not getting as much rent. So you might want to take a look at who your tenants are, make sure that they're, in today's turmoil, that they're able to pay the rent. And of course, then this becomes a very, very good investment for you because it starts to cash flow. No matter what your business does, no matter what your company does, if you start to see that your income is curtailed, you're going to have a separate income stream from these residential rentals, which are very, very conservative investment, and they're a great store of wealth. So even if you're outside the country, this is a great place for you to put money into, in a great markets of the country. Florida, Texas, and Arizona, and these are great places for you to invest. These are great places for your clients to invest. They're going to get cash flow, going to get consistent cash flow. They're tax advantaged. They're not correlated to Wall Street, so we're going to watch that income grow and grow and grow. And in these marketplaces, we have a lot of people are leaving a lot of the cities. You see New York, Chicago, Los Angeles, a lot of places in Seattle, a lot of places are leaving and coming to places like Arizona, Texas, and Florida. So our growth here is going to be phenomenal. I think it's a great place for you to invest. If you have any interest in getting involved with us, we'd love to talk to you. You're welcome to reach us at Creating Wealth at westusa.com. You can reach me at Michael at michaeldouville.com, and you can call us at our area code 602-942-4200. We're here to help. We understand this business. We're very, very good at what we do, and we're here to help you. We're fiduciaries. My very best to you. Bye-bye now.